If you have after-tax money in your IRA and you're wondering how to separate it, in this video I'll be covering how you can do that. Welcome back. This is episode 181. In this week's episode, I'm addressing a listener question on a 401k rollover. And Pat writes in that on his own, he rolled over an old 401k into his IRA with Fidelity for greater diversification. However, he now realizes that he made a mistake on his rollover, and he rolled all of the funds into the IRA, including non-taxable or after-tax portion and pre-tax money. And he's now wondering if this is going to create a problem when he begins withdrawing money in retirement. But before I address this, I need your help to continue to grow the reach of this show. If you haven't done so, please click the subscribe button below. And if you're listening, if you could head over to YouTube, search Retire with Ryan podcast, and then from there, subscribe to it, I would greatly appreciate it. So thank you for the question, Pat. And as a quick recap, first, what is a rollover? When you leave a job, many times you have the option to take those retirement benefits with you. And you can do that in three ways. You can transfer it to another retirement plan. You can cash it in and pay tax on it. Or you can roll the money over to an IRA, or as it's otherwise known, an individual retirement account. And you could also leave the money at the company potentially if they allow that. The option of doing an IRA rollover is very popular, especially if you use one of the discount brokers like Charles Schwab, Fidelity, or Vanguard. Many times you will have more investment options than you had in the previous retirement plan if you use a discount broker. And in some instances, it can also lower the fees that you're paying on this money. And I've talked extensively about this. If you want to learn more, go to retirewithryan.com/podcast, and you can search the word rollover to find these episodes. The rollover process is relatively straightforward. You open your new traditional IRA or rollover IRA, as it's sometimes known, with your new company if you don't already have one. Then you contact your previous employer's retirement plan provider and you ask what their process is for rolling over the money. Many companies will allow you to request this rollover over the phone once they verify it's you, and generally they do that by sending a PIN number to your cell phone or in the mail if they don't have a cell phone or email address on file. So as a side note, if you haven't enabled two-factor authentication on your retirement and investment accounts, I highly recommend that you do that. This is when you add a cell phone number or email address to your account so they can send a PIN number when you transact certain business. And this will stop someone else from taking your money. My preference would be to give your cell phone number because it's a lot harder to hack than an email address. You then tell your previous retirement plan provider how much of your account you want to roll over and how to make the check payable. Always make the check payable to your new investment company for your benefit. For example, if you're rolling it to Fidelity, the check would be made payable to Fidelity for your benefit. And this makes the rollover a non-taxable withdrawal. If you make the rollover payable to yourself, then the money becomes taxable. And if you do that, then you only have 60 days to roll the money over before it's 100% taxable. And with all rollovers, you do have a 60-day rollover period. So you don't want to have the money payable to yourself and have that be made taxable. They usually also let you know at this point if you have any after-tax money in your retirement plan. And this would be after-tax contributions that you've made into the plan. After-tax meaning you've already paid tax on this money. And most of the money in retirement plans is pre-tax money. So why do they let you know this breakdown of after-tax and pre-tax money? Because at this point, you can separate the two. And this is where our listener went wrong. So why would you want to separate the two? Because the after-tax money is eligible to be rolled over to a Roth IRA. And if you want to do this, they would send two checks to you for your rollover. One for the pre-tax money and the other for their after-tax money. And by separating them, it allows you to add after-tax money to a Roth IRA and pre-tax money to your IRA. This benefits you because any growth you get on the after-tax money will be tax-free to you and your beneficiaries when you withdraw the funds if you roll it to a Roth IRA, provided you follow the distribution rules for the Roth IRAs, which usually says that as long as you're age 59 and a half and have had a Roth account open for 5 years or more, you can withdraw the gains in your Roth IRA tax-free. So it sounds like the listener didn't separate the pre-tax and the after-tax money and rolled it all over into the IRA. So this presents a few problems. Number one, going forward, they will have to track the amount of after-tax money they withdraw from their IRA every time they take a distribution. It will be a prorated amount, meaning a portion of the distribution will be taxable and a portion will be non-taxable. If they don't keep track of this, then they will be paying tax on this money twice. Normally, IRAs have all pre-tax money, meaning all of the distribution is subject to federal and possibly state income tax. So if you have after-tax money and you don't track that, you're not going to know that you're actually paying tax on the after-tax money again. And your 401k or IRA provider is not going to be helpful with this. There's nothing that's going to signify on the distribution that it's after-tax money. You're going to have to track that. Number two, any beneficiary inheriting this retirement account might not know that this retirement account contains after-tax money and also may pay tax on this money twice. You can do your best job of explaining this to your spouse or your children or other beneficiaries, but they might not understand this, or maybe they forget and they pay tax on the money twice. And number three, any gains on the after-tax money will not grow tax-free because it is in a traditional IRA. And it will be taxed as ordinary income when they or the beneficiaries withdraw the money, as opposed to this money being rolled over to a Roth IRA. So this is obviously an issue. The question is, how can you fix it? You must separate the after-tax money from the pre-tax money. And the way that you do that is by rolling the pre-tax money back into a retirement plan or into a retirement plan. And you must also roll any other pre-tax IRA monies that you have as well at the same time, meaning a SEP IRA or a simple IRA also out of those accounts and into a retirement plan. Now, a retirement plan being a 401k, 403b, or 457 plan are some of the plans that you could roll this money into. So once that is done, you've rolled all your pre-tax money back into a retirement plan, then you could convert the pre-tax money that's remaining in that IRA over to a Roth IRA. Because you no longer have any pre-tax money in an IRA at the time of conversion, you'll pay no tax on this conversion. And once the conversion of the post-tax money is into the Roth IRA, once that conversion is complete, you can then roll the pre-tax money back to the IRA if that's ultimately what you want to do. Now, this sounds complicated. It's really not, but it will involve multiple steps and some time. So Pat, if you're still working and have access to a retirement plan through work, check with your retirement plan provider to see if they allow rollovers into the plan. That is one option, if they allow rollovers. Another option is to open a self-employed 401k plan. If you have some type of consulting business, opening a self-employed 401k plan is relatively easy to do. Fidelity, Charles Schwab, Vanguard all offer self-employed, or they're otherwise known as solo 401k plans. Now, if you don't have a consulting business, you can set one up. And I've read extensively about this online, and there are many recommendations that even if you fill out surveys and you're paid for filling them out, this qualifies as a business and would allow you to set up a 401k plan for yourself. There aren't really a lot of requirements. However, anytime you're doing any of this, it's probably also a good idea to speak with an accountant just to be sure about this. And if you're going to open a self-employed 401k, since, Pat, you're already using Fidelity, opening it with them is probably the best way to go. This way, the money could be moved electronically from your IRA to your 401k and then back after you've converted the money to your Roth IRA. This would be my number one choice, as opposed to having checks go through the mail if you're rolling it back to a company retirement plan. Unfortunately, with rollovers, they're not done electronically. They are still done old school way. I'm not sure if that's for security purposes, because That way there's a check and it's easier to track down a check versus a wire, but they are done through checks. So it is a problem as far as it's going to delay the process. Also keep in mind, if you have a solo 401k plan or a full 401k plan that is your own business with greater than $250,000 in that plan at the end of the year, this may require you to complete some additional IRS paperwork for this retirement plan known as a 5500. It's a form that has to be filled out annually. Now, again, this also sounds a lot worse than it is, but it is something you have to do. And I can tell you that it is doable. I do my own 5500 every year, but if you need help doing it, you can certainly reach out to an accountant or a third-party administrator to help you get this set up. Now, before you undergo all of these steps to correct this mistake, you have to ask yourself, is the juice worth the squeeze? There is a fair amount of work in correcting this mistake, and if you have a sizable amount of money that's after-tax money, Pat, that you rolled into your IRA from your 401k, it may be worth it. Sizable is a different definition to everyone, but in my mind, if you have more than $50,000 of after-tax money in your IRA, it would probably be worth it. Because if you if you corrected this and got this after-tax money rolled over to a Roth, or converted to a Roth, I should say, and then that money sat there for a while, this could grow to a significant amount of money that could be tax-free to yourself or to your family. But if it's $5,000, it might not be worth all this. So I'm sorry to hear, Pat, that you made this mistake. And I hope this story and this podcast will stop others from making that same mistake. So you don't want to roll over your after-tax money in a 401k into your IRA. You want to separate it out. Either roll it over to a Roth, that would be the number one choice, or just take it out and pay tax, or just take it out and then use the money because it's already been taxed. So this, unfortunately, is one of the dangers of doing things yourself, right? We could all do a lot of things ourselves, but some things we really need professional help, especially when we're making transactions of our retirement accounts, when we're doing rollovers. It's a good idea to consult a professional to make sure that you're getting it done properly. Most financial advisors would not have let you make this mistake. So as always, if you have a question you want to have considered for a future episode, you could head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking with you next Wednesday. Take care.